So guys, the fourth thing here on our list is to save for a down payment and closing costs. Now, some people get caught up with tricky language of marketing, like no down payment or low to no closing costs. And there's reasons that is done. And there's ways to make that happen, but it really comes down to the negotiation of the deal. What I would hope to do first here is let's just talk about some of the basics as far as saving for a down payment and closing costs. What are the general rules of thumb? Let's talk about what we do most, which is VA, and how we're helping people right now utilize their VA eligibility to buy a house with 0% down, and in some cases get their closing costs partially or all covered.
So I actually had a VA consultation right now before we jumped into the podcast, and he's a young veteran. He's 23 years old, just left the Marines 2 years ago, and he's actually looking to purchase his first house. I actually met him at a networking event last week, and his goal right now is to do a house hack. His wife works, he works as well, and then they have a little baby. Their goal is to basically utilize their VA loan, buy a house, and then, leverage the rooms inside the property to either, rent them out and, cover their rent. I think that's one of the smartest ways right now if you're in the VA, if you have a VA loan, to be able to leverage it to, have your house, leverage the payment and be able to, live comfortably while somebody else is paying into your mortgage. A lot of people feel that it's very undoable, but it really just, takes a little bit of work, getting prepared, and actually, making the decision and moving forward. And I think the younger generation, that is in the military is more inclined to wanting to do this house hacking strategy. And it's shown that it works out if you execute it well.
Yeah. And I know that some people get caught up on what the county loan limits used to be, and now that's not a thing anymore. So let's talk about how people are using that VA eligibility to get 100% financing when they do their home purchase.
Well, yeah, as of 2020, they removed the county loan limit requirement. It used to be, and I remember seeing it for years, 2004, like 5-ish when we were getting in, it was like 316,000. Then it kept kind of creeping up and it stayed at 417,000 for a few years.
For like a decade.
It seemed forever, right? And so then not until 2020, they actually removed the county loan limit. So you can go up to 3-4 million as long as you qualify for it with no money down. And what we mean with no money down, it means no money towards your down payment. That doesn't mean closing costs. A lot of times we have that misunderstanding where we feel, well, it says no money down, but there's closing costs. Yeah, everybody pays closing costs. It's not like we're going to discriminate just because you're a veteran. FHA and conventional people have to pay and you don't. There's not a great benefit like that. I wish there was, but there isn't. So there is closing costs, and depending on who you're working with, is going to negotiate these closing costs. Obviously, every 3 months, it seems like the real estate market is actually going through different changes. And so before, when there was a limited supply of homes, very difficult to obtain closing cost credits. Whereas now that we're starting to see more inventory, simple economics, supply and demand, we're seeing that sellers are more prone to assist buyers with closing cost credit. For instance, we just got an offer accepted in the Murrieta area for $870,000 with $20,000 towards closing cost.
Wow.
And those closing costs could be towards actually your closing cost paying title, escrow, processing, you got your property taxes, you got prorated interest, you got county recorder. So you have all these fees there. So you can utilize that. Or in this case, they give us options to do what's called a 2-1 buy down. Okay. Again, this doesn't require a down payment, so you can apply those towards closing cost.
So that sounds like it's just around, I'm doing the math over here. It's just about 2.5% of the purchase price, the 20,000 compared to the 870. Check my math if you want to be specific. It's about there. That's not important. The important part is that's kind of the same range that we advise people to be ready to have for closing costs. 2 to 3% in some cases, 3 and 4% in others, depending on what the deal looks like, where it is, what other third-party fees are associated with your closing. So general rule of thumb is you want to have at least 2 to 3% saved, 2 to 3% of the purchase price saved towards closing costs. It's a great benefit when the seller will come to the table and give you some of that as a compensation, but don't expect it. If you happen to get it, guess what? You still got your 2 to 3% saved up for yourself for whatever you want to do. But if they don't offer it, well, you're going to need that money.
That's correct. So the 2 to 3% would be in places, You're going to say like San Diego, everything's different. If you go to Tennessee, Virginia, where the sales prices are lower, you're going to need higher than that.
Yeah.
Because the processing fee, the underwriting fee, the title, the escrow, it's not like it's much cheaper.
Right. They're fixed costs, but because of the price of the house, it looks like a greater percentage.
Exactly.
Yeah,
So
makes
therefore,
sense.
it's going to be a little higher. And then you're considering impounds. Remember, Texas has taxes right now in some areas. They're like 3.5% in
Yeah.
some
Right.
areas.
Right.
You know, Pennsylvania also, they're like in the 2 to 3.5%. And there in Pennsylvania, we just took down a property where it was 670, but the property transfer tax alone was $36,000.
That's right.
So that's more than your 3 to 4% range.
Yeah,
So
and that was part of
really,
the closing.
Rule of thumb is based on the state where you're in, and always good to know what state you're in so you could understand how that applies.
Yeah.
Because that rule won't apply in every state.
Yeah.
Okay? Very, very different. Going back to the down payment, one of the things we're seeing, Andy, that is very difficult, and I'm sure Brian would agree here, is a lot of our clients don't have down payment, and they're asking their parents, or they're asking, there's companies that are willing to give you a down payment assistance because you work part of this company, you've been there for so long, so they'll give you some sort of type of grant. And there is also for like conventional FHA, some grants and some down payment assistance programs.
Yeah.
Now, people don't understand this, that everything comes with a catch. Okay. Whereas with FHA regularly, your debt to incomes, you can kind of push those a little further, but you're coming in with your own down payment. And therefore your interest rate's going to be a lot more favorable. Okay. When you're coming up with the down payment assistance, your debt to income ratios are a little stricter than if you came up with your own funds. In addition to that, the interest rate is much higher because they're giving you the down payment. And when it comes to lending is all about risk. So the less money you're putting out of pocket as a consumer, it's the less skin in the game. Therefore, we're going to penalize you by giving you a higher interest rate. And so those are the things that we have to kind of see where the pros and cons are and see if the cons will outweigh the pros in this case.
So, go ahead. Do you have
No, I was just going to follow up to that. Yeah, these first-time home buyer programs, they advertise no money down, but that doesn't mean no money out of pocket. And, if you're going to be using one of these programs, I believe the best, situation to use it in is when you have some sort of funds, like for your down payment, and you can get away with having that, your closing costs, but get away with being able to pay your down payment through one of these programs. Because what I've realized is that these programs also charge borrower-paid commissions on the lending side. So even if you're getting some credit for the closing costs, usually that's getting absorbed just to pay off your lender fees. So you're still going to have to come out of pocket with your regular closing costs, even though they advertise, you get a 2% loan for your closing costs at the end on top of your minimum down payment. That's only covering basically your loan costs and at times, your down payment, but it won't always cover your full down payment amounts. And that's when you have to get a little bit more savvy. If your agent that you're working with knows you're buying a down payment assistance program, maybe have them chip in a little bit or ask for a little bit more in the negotiations to be able to fully cover that whole amount and not just get in with the minimum, and then you still have to come in with some amount, and then that might be the deal breaker.
Yeah. So this is a good point to remind people, like, be aware what type of loan program you're going to be qualified for, or that you are qualified for, or what the requirements are. FHA is going to have a 3.5% down payment requirement. Conventional is going to be as low as 3%, but what's better for you is maybe getting to 5%. It's going to reduce your mortgage insurance. So there's some nuances to each of these situations that it's important to know that what the down payment requirements are or aren't, and then what the closing costs associated with that will be based on your location, price of home, and all those third-party services.
And that's correct. For the conventional financing, you got to go to 3%, but then your mortgage insurance, because everything's with thresholds, with everything's in scales, right? Like loan to value, 97% is there's less risk. There's only 3% risk that you put skin in the game. So then if you go down to a 95%, meaning that you're putting 5% down, you'll see that the interest rate's a lot more in your favor and the mortgage insurance.
Yeah.
So a lot of times that 2% will make a bigger difference.
Yeah, it can make more of a proportionate in what am I trying to say? It'll make it proportionately better for you, not just incrementally.
And give you a better affordability.
Yeah,
So
absolutely.
if you're looking at, say you're just stuck at that $700,000 purchase price, but because you're putting 5% down, you may be taking that a little higher now.
Yeah.
Because the
Exponentially
interest rate-
beneficial.
yeah.
That's what I was trying to say. I was
There
like,
you
what's
go.
the word I was going to say? Exponentially beneficial.
Aha.